Welcome back, I'm Dhesi. Here's what matters this week. Last week, the Fed held, the Bank of England held 8-1, the ECB held unanimously. So that's three central banks that chose to wait. But underneath the Fed's hold sat three hawkish dissents on the FOMC statement. The dovish bias was retained. But three voting members didn't want it in the statement, and that is the most divided Fed we have seen in a while. This week, the labour market also gets the floor. US non-farm payrolls on Friday, the consensus is 60,000. Some forecasts sit slightly above that. Also, unemployment expected to drop to 4.2%, and then on Friday, that is the data point that shapes the next 2 months of rate path expectations. A hot print leads to the dovish bias gets harder to defend, and a softer print, the case for cuts later this year. Friday is the data point that shapes the next 2 months of rate path expectations. A hot print, the dovish bias gets harder to defend, and a soft print, the case for cuts later this year, strengthens. Everything else this week sits underneath that. Friday's payrolls, the number that resets the conversation. This is the most important data event of the month. US non-farm payrolls on Friday at 12:30 p.m. London. The context for this is continuing jobless claims have been at 2-year lows, and that is a market firming up. But March printed 178,000, which most desks attributed to Easter timing noise. The question for Friday: was April a payback month for March's strength, or is the labour market genuinely accelerating? The unemployment rate is a second number to watch, expected to drop to 4.2%. A tight labour market, the kind that gives those three hawkish dissenters serious ammunition. Average hourly earnings is the third, subdued at 0.2% month on month. That is the expectation. If wages stay subdued, even as employment holds up, the dovish camp can argue inflation pressure is energy-driven and transitory. If wages start to firm, the inflation problem becomes structural. For rate desks, this is a binary event. A hot payrolls, hot wages, then front-end repricing higher a lot faster. However, soft payrolls, soft wages, the easing case strengthens, front-end extends lower. If there's a mixed read, we end the week roughly where we started. The Friday print also lands alongside Michigan inflation expectations. Long-term expectations are what the Fed has told us they are watching. Michigan drifts higher, then the Fed's tolerance for the energy shock starts to evaporate. The Fed's three dissents, what they tell us about the next move. The Fed held last week at the 28th-29th April meeting. The statement retained the dovish bias, but three FOMC members dissented. They didn't want the dovish framing in the statement. Three hawkish dissents on a statement is a clear signal. Meaningful resistance inside the committee to the easing tilt. Powell has held the dovish line publicly. Internally, the consensus is starting to fray. Why does this matter for the path forward? When the next data print comes in, the dissenters will use it to push for a more neutral framing. A hot payrolls number on Friday, and they get vindicated. A series of hot inflation prints over the coming months, and the dovish bias becomes untenable. The market is pricing renewed easing for the fourth quarter. The first 25 basis point cut likely in October. That is a long way out from now. The path to October goes through several more inflation prints and several more payrolls. The other piece of context, Powell has committed to remain as governor when his chair term ends, and that delays the Trump appointee filling a board seat. Continuity at the policy level, even with Walsh coming in as chair, that should reduce some volatility around the transition. For positioning, however, the front end is pinned. 2-year dollar swaps at 4.08%, the 10-year at 4.31%. The market is not pricing aggressive cuts and is not pricing aggressive hikes. It is pricing patience. Friday tests whether that patience survives. The energy story: Hormuz, OPEC Plus, and the inflation transmission. Brent is at $108 today, down nearly 4% on Trump's signals about Hormuz relief. This is not a clean trend. Last week alone, Brent dropped 6% if we look at last Tuesday, and they were on Trump's comments about Iran being in a state of collapse. They then rallied 7% on Thursday as headlines reversed, and then fell again on Friday. That is a hedging nightmare price action. Two things over the weekend that matter for this week. OPEC Plus announced they will raise June production by 188,000 barrels a day. A supply response, but a modest one. The US announced it will guide stranded ships through Hormuz, a partial de-escalation move. But the strait is still effectively contested. The transmission channel is the same as it has been for the last 3 months. Higher oil prices feed into higher headline inflation. Higher headline inflation feeds into inflation expectations. If long-term expectations drift, the Fed's wait-and-see stance comes under pressure. So far, long-term expectations have been broadly anchored. The longer this goes on, the harder that becomes. Also, Detroit carmakers warned over the weekend of a $5 billion commodities cost shock from the Iran war. That is a real economy starting to absorb what the futures market has been pricing for weeks. When the Q2 corporate earnings calls start to reflect this, the equity story changes too. For commodity exposed industries, energy importers, automakers, transport, chemicals, the hedging conversation has shifted from spot risk to duration. Nobody is pricing in this resolving in the next quarter. So moving on to dollar swaps, 2-year at 4.08%, 10-year at 4.31%. The curve is positive. The forward end has come back up over the past week as we saw the 3 dissenters that started to weigh on the dovish framing. Friday's payroll is the catalyst though. Hot print and hot wages, the 2-year tests higher levels and the curve stays positive. As soft print, the 2-year compresses, the curve flattens further. The market has priced patience. Friday tests how patient. Sterling swaps, 2-year at 4.5%, 10-year at 4.72%. The Bank of England held with a 8-1 vote split. The one dissenter went for a hike. That is a more hawkish stance than the consensus framing suggested. The market is pricing a June hike and 3 cuts by year end. A curious combination. The buy side is skeptical of that path. Euro swaps, 2-year at 2.93%, 10-year at 3.1%. The ECB held unanimously, but flagged June as the next decision point. Consumer inflation expectations in the Eurozone moved sharply higher last week. If that trend continues into June, the ECB has to act. So for practitioners, the next 4 to 6 weeks are about data dependency. Every print now and June matters. Position lightly, react fast. So 2 channels, dollar first, euro dollar 1.17, cable at 1.36 and dollar yen at 157. So the dollar has softened over the past 2 weeks as the Fed's dovish bias was confirmed and the market priced patience. The yen, however, has strengthened sharply. Dollar yen down nearly 2% over 5 days as Japanese intervention talk built and overnight intervention headlines hit on Friday. The yen story is the most interesting FX move of the past week. Last week, intervention took dollar yen from 160 back to 157, and that is meaningful. The Bank of Japan and the Ministry of Finance are clearly defending a level, not just smoothing volatility. The 160 mark in dollar yen has become a line in the sand. So for carry trade unwind risk, keep watching. If yen strength continues, leverage positions in higher yielding currencies that are funded in yen come under pressure. Aussie dollar yen, Mexican yen, Brazilian real yen, watch them as early warning indicators. Moving on to cable, that's at 136. Sterling has been resilient despite UK fiscal headwinds and the energy import exposure. Capital flows from the Middle East and the US are doing more work than the policy outlook. UK local elections also this week are a watch point. They could create sterling volatility if the rate reads as a referendum on the current government. Moving on to euro, it's sitting at fair value relative to rate differentials. The next move depends on whether the ECB has to act in June. The ECB acts, the euro rallies. ECB holds, the euro drifts lower against the dollar. Brent at $108, and that is down nearly 4% over the last couple of days on Trump-Hormuz signals, but nearly 12% over the last 10 days. The volatility is the story. This is not a market trending in either direction. It is a market reacting to every single headline out of Washington and Tehran. The fundamental backdrop, OPEC Plus raising June production by 188,000 barrels a day, that is the key headline. Also, the US offering to guide ships through Hormuz. Iran continuing to threaten escalation. Detroit carmakers also flagging a 5 billion commodity shock. Add it all up, supply response is modest, geopolitical risk is high, the real economy transmission is starting to bite. So, inflation expectations are the key variable. The Fed's wait-and-see stance assumes long-term expectations stay anchored. Expect eye-watering inflation print in the coming months. Year-on-year core PCE could approach 4.5%. That is a level which historically forces central bank action. The argument for the Fed waiting, Walsh has signalled a focus on labour market deterioration over inflation expectations. Coherent but contingent on labour market data delivering the deterioration. Friday's payrolls is the first test. Also looking at gold, that's at 4,596. That is down 3% over 10 days. The safe haven bid has been unwinding as central bank policy clarity has improved. Gold is no longer the dominant defensive asset. The yen has taken some of that role over the past 2 weeks. So watch whether gold finds a floor here. S&P 500 at 7,241. That is up 1.6% over 10 days. The S&P just closed out April with a 10% monthly gain, the best monthly performance since late 2020. Earnings season has been strong. The Mag 7 names that reported last week largely beat expectations. So the question for the next 2 weeks, can the rest of the index carry that momentum? This week is more selective. AMD reports today the stock is at all-time highs after a 62% year-to-date gain. The semiconductor index is pricing perfection. Disney also reports on Wednesday under its new CEO high expectations for the turnaround story. Marriott also on Wednesday, travel resilience versus Middle East geopolitical drag is the question. Also Euro stocks at 5,890, and that is down 1% over the last 10 days. European equities have lagged the US rally as the energy exposure really starts to weigh in. Watch the auto names as well. Given the Detroit warning, European autos with similar supply chain exposure are also vulnerable. The Nikkei is at 59,890. The yen strength has been a headwind for the Nikkei rally, so sustained yen appreciation pulls Japanese exporters off their highs. Moving on to credit, US investment grade at 81 basis points, US high yield at 277 basis points. So spreads tightened further this week. So the setup remains asymmetric, limited room to tighten further from here, but there is room to widen on disappointment. Moving on to crypto, Bitcoin is at $80,000 and that's up nearly 4% over the last couple of days. The first weekly close above the key resistance level. So crypto has been leading risk on for the past few sessions. So worth watching as a real-time sentiment indicator. ETH is at 2,380, which is also bid. This is a payrolls week, so let me walk you through it day by day. So Tuesday is the first key day. The Reserve Bank of Australia decides, a relevant signal on whether central banks globally are starting to lean less hawkish. Also, US ISM services PMI lands in the afternoon, 2 p.m. London. JOLTS job openings, the same time. AMD also reports after the US close. Wednesday is light on data with ADP employment at 12:15 at London time, the unofficial precursor to Friday's payrolls. Disney and Marriott also report. Then on Thursday, initial jobless claims. Watch the 4-week average more than the headline. It has been at 2-year lows, so Friday is the dominant story. US non-farm payrolls at 12:30 p.m. London, unemployment rate, average hourly earnings, Michigan inflation expectations at 2 p.m. London. This is the 4 data point package that resets the rate path conversation. Underneath all of it, energy and Hormuz. Any escalation or de-escalation headline can move the dollar and Brent before any of these scheduled events has a chance to register. So that's your week ahead. Bookmark it, come back on Friday, see how it aged. I send a daily version of this every morning on Telegram. It's free, the link is below. Subscribe if you want the next one and drop the one level you're watching down below.